Hi, I'm Nick, CEO of ILUS International, here to you today with this long overdue podcast. Long overdue because we've really been focused on delivering the deliverables, and I think it's been an extremely frustrating period for everybody, from JP and I's point of view, because we are guys to get stuff done. We're not guys to talk and not be able to follow through, and we felt that the last 12-18 months have been extremely difficult to get things done because of the macro market conditions and various headwinds. However, that doesn't deter us, and we have been very focused on getting that done as opposed to spending our time talking and infuriating everybody around us because the deliverables have not been met yet. So please take our apologies for this delayed podcast. We do hope now that as things are starting to crystallize, an overall business plan, we'll be able to come to you more regularly with podcasts and regular updates. There's nothing more frustrating for you to hear from us and then us not to be able to deliver on what we tell you. So, that being said, take our apologies. Please don't feel unloved. We love you all very much. Our shareholders, our current shareholders, past shareholders, and potentially future shareholders, as well as the supporters who sit on the sidelines, are very, very valuable to us and as one community and as one family. And I thank you very much for that. So coming onto the business and the nitty gritty, I'm going to do my usual and touch on the sort of the macroeconomics, because what's happening in the kitchen does affect the nano markets. The rats and mice like us and everybody on the OTC space. I think I came to you with a podcast, I don't know, at the end of last year, early part of this year, and I don't think my macro forecasts were particularly a million miles off. I basically said that it had been a tough 23, and explained some of the problems that had gone on. The likes of the SEC clamping down on the small hedge funds / family offices, nailing them for not being registered dealers, broker dealers, and that sort of had wiped them out of the market. A lot of them were underwater because of the price crash on the OTC, which was partly connected to the crypto crash, 22, 23. So all that sort of wiped out a lot of the liquidity out of the markets, and sort of the dumb money, if we want to call it that, but the day traders who had only just dipped in since COVID and were new trading, that their potentially strategies weren't solid enough and kind of got wiped out, and that ultimately affected liquidity, which ultimately affected the ability to raise capital, which naturally has a knock-on effect into absolutely everything involved with the business. So while I kind of touched on that a little bit more in the last podcast, that condition remains. A few more of those small trader funders have been taken out the market, which has continually made it very difficult to raise money in general, but be able to raise good quality money that is not dilutive to shareholders, or not particularly toxic to shareholders. However, the clean money is very, very difficult to find. Very, very, very difficult. So we've had to do what we've had to do. While we're not proud of it and don't like it, it's been absolutely essential, to get us to our business plan. And as we've touched on, earlier in this podcast and previous podcasts, on those of you that have met us at shareholder meetings, we go for the win. That's the way we've always done it. That's the way we continue to do it. And it is a win at all cost basis. We're not there to take prisoners. And if we've got to make some unpopular decisions along the route, then so be it. And unfortunately, the funding mechanisms that we have in place and continue to do, we know are unpopular. But unfortunately, it's a necessary evil to get to our goal. We hope now that as the goal comes into sight, that this becomes a short-term pain that will wash through, in the short medium term. So that says, still sticking on that macro strategy. The funding continues to remain difficult. As I did say last time, I felt that interest rates and kind of the inflation would slow down, and interest rates, maybe that was my timing was slightly wrong. I kind of thought that there maybe had already been one reduction in interest rates, but it's imminent, coming through the last quarter of this year, the last half of this year. Probably by Christmas we'll have one. While just for those that maybe are not into the economics of Wall Street, what that really means, it's not the fact that we might get a convertible note at 1% cheaper or a few points cheaper. It's the trend of the way the market moves. And again, this is sort of, let's say, economics for dummies, and I'm not an economist, so don't take this as black and white and it's gold dust. But what that does mean is when some of the funds have been sitting with money on long deposits or sitting with money in banks that they're getting a reasonable return on. There's no need for them to take a risk on any type of stocks. Whereas time moves on now, when they know that the likelihood of the trend of downward interest rates, they'll start to look to get active again and start to deploy capital, deploy dry powder, as we call it. So that should have an impact on ability to raise funding, good quality funding, and the amount of funding available in the market, and the liquidity in the funding. Because while they're putting money out, not just to us, to everybody, that will start to wash through as the liquidity starts to increase. They get out of their positions, people make money, the stock goes up. The whole sort of cogs of the machine start to get lubricated and start to turn. So it's not about a percent or 0.5% or a couple of percent on a note or a debt that we have. In our terms anyway, I'm talking. It's really the macro picture that sort of starts to improve, and the same then knocks on to property. The property market is obviously at an all-time high most instances around the world. And in recent times, that's not because of a massive over demand. It's typically because there's been a shortage of supply. Because people that have a house, yes, it may have gone up. They may have a huge amount of equity in their house, but if they want to move to a new property, the property prices have gone up, so they'll be spending more to buy a new place. But at the same time, they'll be taking out a mortgage at 7-8% or whatever it might be, as opposed to their current mortgage they're sitting on at 3%. So they're just not selling, which is obviously meaning the supply of properties is less, which is obviously meaning the price of what is on the market is going up. Now when interest rate starts to drop, that should start to again get things moving a little bit more, which again will allow people to do property deals, and kind of again which affects their personal liquidity, which again leads to some form of liquidity into the stock market. If they're taking out equity out of their properties, and or however that may work. So again, I was not a million miles off on my last macroeconomic things into December, January, whenever it was. I predicted all these things would start to happen, during the course of this year. It's taken a bit longer than I thought, but it looks like it's starting to move that way. So naturally on people's personal lives, a few percent reductions off the interest rates in the next 6, 9 months, 12 months will again start to bring things a little bit more into control on their credit card payments, their loans, their holidays, all that daily inflationary stuff, which again may get people back into the market. They may have a little bit more pocket money to spend, investing in the markets. And that all again impacts on the ability to raise cash if the liquidity is there. I also predicted, which was quite important, which I think I've got close to being right, was that, as I said, a lot of the OTC and nano cap companies would cease to exist, not be able to raise capital, dry up, basically disappear, which has happened. And kind of what I predicted was that there would be fewer companies on the market. Although there'd be less money and less liquidity, there would be fewer companies on the market, and we felt that we're well positioned and one of the stronger ones with a relatively strong shareholder base. So our liquidity may actually improve, in the short medium term, while others find it particularly difficult. And I was, I'd like to think I was relatively close to the shot on that one. Our liquidity, while at a ridiculously stupid low price, we are still trading millions of shares every single day consistently, which is better than probably the majority, if not all, of the OTC companies. And as those that followed the interview last week with Buffalo Fireside, We've done particularly well to kind of continue to harness that shareholder base, and particularly well to continue to trade with that liquidity, which has helped our ability to raise money. Whatever terms the money's come on, it has helped. Where we found it very difficult in some of the subsidiary companies where we've had much lower liquidity points. So, and I run let's say a monitor that I look at kind of 25 odd stocks, OTC stocks, not in any particular order, not for any particular reason. They're just a random spread of companies that I kind of monitor purely just to feel what the trend of the market is. When everybody's having red days, green days, just so I can kind of keep a track on where how far out of kilter or in kilter we are, with the general market conditions. And out of those 25 companies that I follow, 11 of them are not even trading anymore. They've been CE'd. And as I said, they weren't particularly good companies that I followed. It was just a random matrix of companies that I just literally picked out of a hat. But I'm sure based on that, 11 out of 25, if I extrapolate that to a bigger number, it's probably, hundreds of companies that are no longer trading. I'm sure you guys will feel the pain of stocks that you're sitting on that are no longer trading and you can't get out of your positions. So while we, in the dog basket and kind of, really in the doldrums in terms of our share price, the good news is our liquidity is still there, which means people still want to buy our stock. We still have that loyal supporter base. So that is good news, which means as money starts to flow back, we're probably in a slightly better position than most to be able to maximize on that potential, that opportunity. I also touched on the crypto market before. The crypto and OTC markets, is very connected for whatever reason. I guess it's the same sort of trader that is trading crypto after hours and trading OTC and basically playing on that high volatility of, massive movements in stocks. So crypto seems to have stabilized a little bit. I don't know what's going to happen in this next period. So let's see. Things are starting to feel like they're moving in the right direction. Not in any speed. We're certainly not breaking any speed records here. But the good news is it's moving the right way. Without any emotions involved, a change in government later part of this year, could leave the capital markets in a real bull run for into 2025, aligned with interest rate reductions. So I feel we're in a relatively good place to capitalize on that going forward. As we've touched on earlier, it hasn't been an easy ride. It's been a bloody difficult ride over this last 18 months, 20, even a bit longer, in terms of raising capital, in terms of the market expectations, in terms of getting deals done, in terms of just the operating costs of operating the business. We'd like to think we've weathered the storm as well as could be. We'd be in a very different position had we been able to, raise more capital on better terms. But we can always say if. That's not a reasonable expectation to think about or look at. The bottom line is we have our goals, we have our business plan, which I'll touch on a little bit later, and we haven't diverted from that, and we're not about to divert from that. The routes may be slightly different, but we are flat out on target to achieve what we have set out from day one. So kind of I'll leave the summary on the macroeconomics that we're more or less where I expected the world to be. At the moment we haven't had any major drastic crashes, touch wood, and for some reason, somehow, somewhere, the world seems to be weathering it. We've obviously got a massive risk around commercial paper, where in commercial real estate, where we've got offices sitting empty. That I feel is going to start to change again in 2025. I think a lot of banks, a lot of regulated businesses will start to force people to come back to the office, probably full time, is my prediction, because I think there's a lot of risk around, for example, like people like SEC working from home. How can they work from home and handle our files securely in their house? And banks are the same. We've got bankers, investment bankers, all the banks, insurance industry. There's a ton of regulated industries that shouldn't really be working from home. It was convenient, and we kind of got led by, the millennial generation after COVID saying, well, I'm not coming back to the office. I think those days are over. And I think the world needs people to go back to the office for a number of reasons: to stimulate the local businesses in those areas, to get real estate property being able to be rentable and affordable again, to stop a major crisis. If all the companies don't rent space, those landlords take defaults, it hits the banks, and we know how that cycle goes. But I feel like we're sort of maybe moving in the right direction. We're starting to hear the noises of people going back to offices, and again, back to the office point of view is, it's the trickle training. We know from our staff, some of them will work from home on, sort of alternating days or however it may work from the different businesses. What you lose is the brand value. When somebody joins a company and they don't even know who the rest of their teammates are because they've never met them before, or they've met them twice, you don't have that stick together, fight through thick and thin, I've got your back type of attitude. You just don't have that because people don't even know each other, which also makes them less loyal to companies. They kind of just move on, if somebody offers them more money, which again is not sustainable for businesses, in the longer term. And also, most importantly, for their own careers. And I think, kind of the work from home, post-COVID type of generation don't appreciate the value of trickle-down training, which you can't buy. You can't learn it at university, you can't learn it from a textbook, and you can't learn it over Zoom. That trickle-down training comes from talking to the guy at the water machine who's your boss of 25 years. It's from talking to the guy on the other floor who's maybe in a position that you would like to get to. It's from that experience that you gain, from being hands-on, face-to-face, eyeballing people, having coffee with people in the office, and kind of learning hands-on, which doesn't happen in Zoom. Zoom, you have a 20-minute call or an hour meeting every however often, and you then heads down on your own laptop and getting on with it. You don't have that person to lean on and that person to learn from. And ultimately that holds people back in their careers because they just don't have and they don't gain that experience that they would have if they were in an office, which longer term people are going to find is going to hold their careers back massively. And again, coming back to the point, I think those days are going to start to come to an end. People want to be out, they want to be meeting people, they want to be learning new things, they want to be enhancing themselves. And yes, there's a payoff between the balance of lifestyle, and being able to be there for your family and having a bit more flexibility around working hours. But ultimately, it's just a balancing act that the world has to deal with over the next forevermore. So on that note, let me move on to kind of some of the more business stuff that's a little bit more interesting to you probably, and we will cover the different topics. Here we go, bear with me. Right, so I want to talk on just on our strategy, our ILUS strategy, and just reiterate and remind those that have forgotten. Our strategy has never changed. I'd like to underline that and put that in bold. It has never changed from day one. From the very, very first day of our operation and announcements and the very first shareholder meeting, and it has been continuously consistent. What has changed and continues to change, and that is really down to market conditions, is the route to reach our target and reach our goals. And that I think is the same probably with any micro and nano cap business, purely because you don't have the luxury of huge cash reserves that you can basically weather every storm. So, as a storm and as we get headwinds and as things are thrown at us, we have to divert and pivot around to avoid, those particular challenges. Where, if you're a little bit bigger and a little bit stronger, capital-wise, that you can kind of just ride through them, knowing that it might be a 6 to 12 month blip or a 6 to 12 month headwind, and you're going to ride it through. Obviously, we're not fortunate in that position, and I don't think there are many or any OTC companies that are in that position. So that being said, that's the change that people see and hear and talk about, that we're changing our plans, they don't know where we are, they don't know what we're trying to do, which is absolute garbage. Our plan of where we're trying to get to is absolutely crystal clear. The route there is dynamic, it is fluid, and it does change, consistently, or alter course consistently to reach our final goal. And again, I did touch on that in January podcast. I said, I think I used the analogy of, going out to go sailing to an island somewhere for a barbecue, and you come out and the weather changes and you kind of change route, you change plans. But it doesn't mean you're not having your barbecue. It's the same sort of principle here. So let me kind of underline. Our plan is to really acquire small, medium-sized businesses, bolt them together and grow a roll-up strategy on individual verticals. So to grow those businesses, adding value, and to grow those businesses by, as I said, adding other businesses to them, by adding sales and marketing capability and marketing skills, by bringing in experienced board people, by adding value in the supply chain, and ultimately, eventually adding value through increased capital ability to those companies so they can grow faster. And through strategic overview and oversight of being able to develop those businesses in growing sectors where we feel those markets will develop, those markets will expand, and we have a cross-pollination where one vertical can be cross-selling into another vertical. So while that may not always appear clear on kind of what the overlap is with some of our businesses, it will slowly become clearer as those businesses develop and grow. So that being said, that hasn't changed. Now, where I think some people get confused is where do they see the value, or how do we realize value? So we really are growing on a conglomerate model, and I know it sounds ridiculous. We're kind of a nano cap, even smaller than a nano cap. But all big trees come from a seed, right? So where we're trying to grow is we've got very clear verticals, we've got very clear business segments. They would be a lot bigger and a lot faster with a lot stronger members of teams by now had we had the capital, as I said. But looking back at ifs doesn't matter. What we need to be is we need to be in the position that as market conditions improve and we're able to take capital down and we're able to find ways to get capital, those businesses are all well positioned and well placed to really blow up and expand. So where we should get to is the value of each of the subsidiaries added together should be our minimum valuation at a parent company level. In fact, we should have a premium at a parent company level because that all those we're quite robust and all those companies have the ability to grow and us to bring more companies in. However, typically in a conglomerate situation, that doesn't always happen. Hence why you have spin-outs, because typically you might have one subsidiary that just can never reach its full valuation while it is totally a subsidiary. And so basically it needs to be able to spread its wings, and it needs to be able to fly the nest. And that's when we start to see real value starting to come back into the parent company's balance sheets. And that's always been the plan. That's always been pretty transparent from the beginning. But what that does create is it does mean for shareholders is that, and again, I'm not an investor, an advisor. This is not an investment advice. It's not saying buying our stock, don't buy our stock. I'm just putting facts on the table. That typically what it does mean is that in the longer term, our shares should always be more robust than the average OTC company or average any listed company. A conglomerate shares usually should be more robust because they're able to stand more of weather a storm because they have multiple legs. So if one sector is doing badly, another one might be doing well. They're able to divest and sell off subsidiaries to raise capital should they need to. We're not in that fortunate position yet that we're just a little bit too early on that, but we're rapidly reaching that point where our subsidiaries are worth something, and will be worth something to someone else should we want to offload them or divest certain parts of our stock holdings. But what we're really meaning is that at the parent company level, we should always have a position where the shareholders feel safe that between all of our, let's say, eggs in the basket, one or two or multiple of those will have a big valuation at some point in the future. They're not all going to be highly successful. That's business. We hope, as a board, we get the majority of them right, but certainly some of them should reach the maturity that we would hope they would, and that's where we sort of start to get a big payday. And again, I've said this multiple times in the past, and I'll continue to stick on the same thing. We're not a stock for 1 day, 2 days, or a week. We're building a long stock for generationals. We're building a stock that at some point in my lifetime, I hope will get to hundreds and thousands of dollars a share. And that takes time. I'm talking decades. I'm not talking days or weeks. But that journey to go from 0.006 cents to, I don't know, $1, $2, $10, $20, $50, $100, whatever it might be, that's the sort of the value creation. We can't fast track that. There is just no way to sustainably build a huge business overnight. You just can't. And I know Wall Street's impatient. I know day traders are impatient. I know shareholders are impatient. One of the questions last week on Buffalo Fireside's question was, how do we create euphoria? We're not about creating euphoria. We're about building a business with a solid balance sheet, cash on the books, businesses that are all performing and growing, and allowing our business as a conglomerate to reach the goals that we need to, and be able to take in new businesses, incubate them and grow them, and build out that massive balance sheet and that massive value that we want to create for the shareholders, which is over time. Now that doesn't mean that short term, there isn't opportunity for share prices to go up, considerably. But it's not about us posting a picture of a delivery or a customer installation. You don't see big board companies, you don't see Nasdaq companies posting a picture of them doing an installation of a fire system. I mean, you just don't see that. That's not the space we're in. We're not a pumpy stock. We don't want to be a pumpy stock, and we're not going to play in that space. And I know we perhaps have been too quiet on the news. And now that's something we need to work on internally, and I think I touched on it in that presentation last week. It's really about us. We don't want to be telling you stuff that is still a little bit fluid and still not not concrete, because then we just get criticized, and then we criticized if we don't tell you. But we're very particular on just delivering these deliverables. We know once we deliver and the flags are in the ground with certain deliverables, that confidence in us as a board and that confidence in us as a company will come back. And we're well aware that it's not totally there right now, and we thank you to those shareholders and those followers that do believe in us and are supportive of us and do believe it's coming. So just touching on back onto that point, we have that plan now. If we look at our current position, so we've got our QIND subsidiary. The valuation of that subsidiary is going to come out in the next few weeks. As we get to closing time of the ASNS deal, which is obviously public. You can read the 8K filings. You can read all the material announcements that have been made. We're still tracking well in that time zone in the required time to close that deal. At this particular point, there seems to be no headwinds and no issues with us moving towards closing that deal. So if we look at the QIND business on its own is valued, north of 50 million. So we've got a market cap of 7 million. So there is an undervalued stock. Now I'm not investment advice. I'm not saying buy shares. That's not what I'm trying to say at all. I'm just saying now, obviously, if you now look at the parent company ILUS, we've got a 14 million market cap. Well, we're the majority shareholder of QIND. So kind of, again, if that value, when that value, not if, because it will, when that value materializes up to parent company level, whether that's now, in a week, a month, a year, or 3 years, eventually it has to. And that's our job as a board, to harness that value for our shareholders. And whether that means divesting some of our stock, whether it means selling a subsidiary in the years to come completely to realize that value, it doesn't matter. We still own that value. It's ours. Ours being all of ours. You guys, us, me as the largest shareholder. It's our value. We've got to harness that and grow it. Although that may not show on the scoreboard right now, the value really is there and really does exist. And our job now is to try and get that to appear on the scoreboard, which obviously appears in your brokerage accounts. So now if we look now at our ILUS market cap, 14 million, we know we own the QIND side, which don't quote me on the valuations yet, because all those valuations will start to become public through as this ASNS deal closes and there's a fairness opinion, etc. So I think the valuations for the ASG group that we acquired could be north of 60 million. Now, why is there a fluctuation in valuations? We've heard 30s, we've heard 50s, we've heard 60s. We obviously own 51% of ASG, right? So you have to discount all of that down. But what I think some of the market don't understand, and this, excuse me for those people that do, this is really an informational point of view, is that the valuation of a public company and a private company are vastly different, and they're also multiple different ways of doing valuations, and it's not based on the market cap at all at this particular point in our life cycle. The ways they're looking at it is discounted, DCF, discounted cash flow models, over a 10 or 15 year period. They're looking at an EBITDA model based on other public companies in similar industries. They're looking at multiples of other particular industries, other particular businesses on a like-for-like basis. So they're looking at ratios basically of companies that have got a certain amount of cash in their balance sheet or have done a certain amount of deals, turnover, what percentage of people's stock price as a percentage of their turnover, of their profit, and they build out this massive algorithm, this massive matrix, and then they sort of run those models on our scenario and then see how that basically looks. So that on that basis, the valuations are not based on, well, we acquired a business for 10 million. We've seen people comment on this multiple times. Well, they acquired the business for 10 million, so of course the business is only worth 10 million or 20 million because they bought 51%. That's factually incorrect. And that's obviously, again, where we add the value. You buy a private business, and you now start to bolt it together. You give it liquidity, you give it cash to grow, you allow it to spread its wings, and you start to extract the proper valuation from that business. Because people that may be buying ILUS stock or any public company stock are maybe not buying it today. They're buying it as part of their pension for 10 or 20 or 30 years' time. Therefore, the valuation is all kind of calculated around those type of modelings. So, I just thought I'd share that with you. So while you look at a valuation now and you say, okay, well, or whatever, Samuel's profits is X, so maybe they're worth 2 times that, 3 times that, 10 times that, whatever. That's not a way to value a public company business. And there's tons of YouTube stuff available online for those of you that are really interested in that. You can go and do your own research and kind of, value it up. And that makes it obviously relatively difficult to value a share price, especially on an OTC market where kind of the common sense, the reality, and the financial modeling are not aligned at all. The casino of the OTC market is pretty volatile, and people are buying a share price today based on what they feel it might be worth without even looking at the fundamentals of the business. And this is where our job comes in. Our job is to basically ignore that, to ignore the noise, to ignore the smoke and mirrors that gets thrown in our faces all the time, to ignore the pressure of Wall Street to basically deliver euphoria today. It's about focusing on what do we need to do. We know we have the QIND business. We maximize the valuation on that business. We grow that business out as fast and as hard as we can within the constraints and the capital we have. And we know eventually that's going to wash through in one way or another. And now the same as Samuel, slash ERT, that business hasn't been able to grow its wings, to flap its wings yet because of our constraints on capital. Hence our move up to the big boards. That will now start to free up some proper capital to allow it to grow. Both Georgia and Bullhead and Firebug, they've got more orders than they can deliver, but we physically can't deliver them because of the capital ability. As soon as we take on new business, we have to have more inventory, which costs money. We have to have more staff to take the orders, deliver the sales, do the accounting, pack the orders, process the orders, do the estimation, whatever. Those staff cost money. You then deliver the goods to the customer, you invoice the customer, and you wait 30, 60, 90 days, depending on the customer and the market, to get paid. So you're out of money for inventory, you're out of money for staff, you're out of money that you've now put out into the customer waiting to get paid. So each time you grow, it takes a significant amount of money. And we've had to pull back on the reins on terms of growth to be able to get this uplisting done, to raise the capital, to actually throw the capital into those businesses, to allow them to flap their wings and really fly, which is when we'll start to see the operational value come into those businesses, which ultimately will flood through into the value of the businesses. So that said, people have asked about, well, when are we going to see value on to the ILUS shareholders? When are we going to see it, etc. Now, so if we look at SAML market cap 3.8 million roughly today, QIND 7.7 million roughly today, ILUS at 14. Well, we know QIND is north of 30, 40, 50, up to 60 million valuation. SAML is probably not far off that, because it's got a massive technology play, and it's got patents that are worth a hell of a lot of money that just haven't been able to be utilized to its maximum potential yet. We haven't rolled any of our patented products, or much of our patented products, out into the US yet. I know JP will talk in the next few weeks about kind of the individual businesses, and we spoke on this conference last week about attending expos and trade shows and that type of stuff. When we have the capital to do that, we'll do that, and we'll start to see that that revenue model come through and the valuations come through. But all of those sort of, that valuation is one thing. But now we have eRaptor and Replay, which are completely undiscussed at the moment, because while we've got the technology and developed the business models, developed the framework of the business, we haven't pumped any money into rolling those businesses out. Well, Replay and eRaptor could be double both of those, all the rest of our group put together. So that's the seed that we're kind of germinating, in our conglomerate. So I guess it's down to you guys to evaluate whether, not talking about today, but whether over the next 1, 2, 3, 4, 5 years, you feel that the value of those total businesses is going to be more than where we are today. That's a question for you, not me. So I tell you, I wouldn't be doing this if I didn't believe we couldn't do that. So where's the value for shareholders? Well, that's the value for shareholders. Between the next 1 week and 10 years, are we going to be worth significantly more than where we are right now? That's a question for you. But as I just said, JP and I wouldn't be doing it if we weren't creating something substantial here, and the rest of our team wouldn't either. I think we did cover it last week. Our team are working phenomenally hard, underpaid, and some of them not paid at all, working without pay at the moment as we kind of grow this business out, and we'll continue to do that until we reach the milestones that we need to, and cash starts to flow into this business. We're all in it together, we're all shareholders together, and that should give you some confidence. We're not hired from a newspaper advert and just employees and don't give a shit. We really do eat, sleep, and breathe this business. It's in our DNA, and that should give you some sort of peace of mind and kind of confidence of where we're going. So that said, we have this conglomerate of businesses, and we'll continue to do more. There's a bunch of deals in the pipeline. Our deal flow hasn't slowed down in terms of inflow of deals, but our ability to close the deals and push the deals has. We've basically put that on ice temporarily, because as soon as you close the deals, we need to be able to finance the deals. But our financing model and how we finance deals, you guys know the model, right? We put down typically as minimum cash as possible, provide them some stock, and then basically try and pay them out of their own cash. So basically, we look at their balance sheet. If they've got a good liquidity in their balance sheet, or an unrealized liquidity in their balance sheet, i.e. in their receivables, they've got a lot of money due. They've got some big orders coming. We know we'll be able to, over the next 2 to 3 years, we'll be able to pay out their tranche payments out of their own cash flow. So we're only really needing to put down a little tranche of cash up front. However, where it comes in is we don't want to buy them and keep them. We want to buy them and grow them. So buying them is one thing, but then growing them requires cash on day one, requires staff on day one, etc. So on that basis, we have had to hold back because we haven't been able to secure the funding that we need for the existing businesses, let alone more. But also that said, the funders are behind these deals. It's all about timing, and it's about execution, and it's about the funders being able to get liquidity to be able to get their money back, and it's about us balancing not to take on too much dilutive. I want to use broadly the word toxic, but too much heavy termed cash that ultimately we pay the price for later. So while we might add 10 million of value today, costs us more on our market cap short term, medium term. So we are having to play that fine balancing act. Not sure we get it right every day, but I'd like to think kind of on the broader terms, we've got the majority of it right. I know we sat here 6 months, 3 months, 9 months, a year, 2 years ago and said we wouldn't want to reach 1 billion of shares outstanding. Things have changed considerably. And that was our intention then. Our intention every day, every time we authorize an issuance of stock, it hurts. It hurts us a lot. It hurts me personally, and I'm the biggest shareholder. It's dilution directly to me. It's dilution directly to you. It hurts our share price, which makes it more difficult to raise cash in the future. So believe me, we do think very, very closely and carefully about that. However, as I said, things have moved on. The conditions of the market have moved on. We have been able to raise money. The prices have moved on because the price crashed. Not just us, the whole markets in general. So not being able to raise capital at the price you need. Either we just say, no more growth, we're going to fire people and we're going to shrink and maybe not survive as a going concern because we can't raise cash, because we don't want to issue more shares because we're going to go over 1 billion, or we do what we've got to do and we face the music and things wash out later as the businesses grow and things sort of start to reach a bit of an equilibrium. So that said, I hope I've sort of answered some of the concerns or thoughts about the valuations of the business and kind of where does the long-term value come from. And on that note, I'm going to add one more point, which is a little bit more more realizable in the short term. Is as we uplist QIND, our shares, once those shares are registered, I'm talking ours being ILUS, right? So once our ILUS shares are registered, we've been through the whole registration process and the deals are closed and kind of the SEC has given all its blessing and all that wonderful stuff. At that point, our shares are liquid. We now for the first time start to feel our conglomerate status. So what does that mean? Let's just say hypothetically we're sitting on, I'm just making up a number, 20 million shares, trading on the Nasdaq at $2, $3, $4, whatever the price is irrelevant. But we're sitting on real shares that are on a real board, that are liquid, that are registered. We don't need to own 100% of every company. What we do need to do is grow our conglomerate. We need to get more seeds planted and germinating, and we need to get our current seeds in our plants growing up. So, at some point in the future, we may well want to divest some of our shares. Let's just say hypothetically we sell $2, $3, $4 million worth of shares, at some point in the future. It would be no different to you guys trading. We would literally as a board say, okay, cool, ILUS wants to acquire, this semiconductor business or this, spend more money on replay or whatever it might be. We want $2 or $3 million worth of capital, and we don't want to borrow any money, or we want to take in some capital to pay down debt or refinance debt. We may well opt to sell some of our stock, especially if the stock is going well, things are going to plan. We may want to liquidate a little bit of our stock. And that's now where we start to feel the added value. And that capital could be used for a lot of different things. Don't quote me on this, but for example, like share buybacks, like paying down debt. Don't quote me on that. That's not what I'm saying we're doing, because it'll be a long time before we kind of spend our money on that type of stuff. We want to grow out the value of the business. But the opportunity is there for those type of luxuries. Once we have listed our business, our subsidiaries. And the same applies, for DRCR. They're kind of on an aggressive plan to get themselves uplisted too. ILUS owns 10 million shares there. So again, we may well want to offload some of those shares, or at some point in the future, or we may want to look at collateralized banking, where we're actually working with an investment bank to borrow against, some of our stock. We may want to borrow, let's say, 20% of our stock value, to take in real cash, prop and loan, not convertible, not toxic debt, and restructure our whole balance sheet. All those opportunities are there. But right now we're in the swamps. We're getting our deals done. We're getting these uplists done. We're moving towards our goalposts. We're moving towards our conglomerate business plan. And we're having to be fluid how we get there. But our plan of getting there is pretty clear. And that is unlikely to change. And I think that's why our loyal shareholders remain loyal shareholders, while the people in the Discord room remain, relatively loyal to us. We know you're angry with us. We know, you're pissed off. We can't fault you. But what we'd like to think is that, at least where we're trying to go, and you kind of buy into our vision, and you believe in it or you don't. We can't convince you any otherwise. All you can do really is watch our delivery and watch our ability to deliver over time. So anyway, that's summarizing on the ILUS strategy. Sorry, it's a long one, but it's important that you guys had a good overview, and I'll kind of touch on some other topics. So just talking about capital raising in general, / dilution. Our dreaded word, the word I've come to hate so much. So I'm not going to go into mega detail on this one because I think we've covered it a lot. It's been mentioned continually and consistently through this whole podcast. Now I think the ability to raise capital has been difficult, will continue to be difficult in the short medium term, and should hopefully become easier as time goes on. We've had to do what we've had to do in terms of raising capital through this let's say shitty period of 18 months-ish, maybe a bit more. And yes, that does mean that we've had heavy dilution, and in the short medium term that's there. We can't avoid it. We have got relatively good terms with the funders, and they really are trying their best not to crush us. I know that you look on a multiple red days we have, and you kind of think, yeah, whatever, they don't give a shit about us, But as I've touched on in previous podcasts, capital is their product. They sell their product to us by giving us capital. They get paper back. If they're unable to convert the paper back into capital, they can't give us more capital because they've got no product to sell. And the same with all the other businesses. If they can't get out of their position, they can't put capital back into the market. So, while we don't want them to sell or convert, and they're not endless pits. These guys haven't got gazillions of money that they can just keep writing checks forever. And consider that we've got relatively good liquidity, and I say relatively good liquidity, and our stock trades particularly well. You have to look from their point of view that they have a macro amount of businesses, so we won't be their only investment. They might have 4, 10, 5, 10, 20 other businesses, so the ones that are doing well, unfortunately they've got to take the cash out of those businesses so they can carry on investing. Otherwise the entire market dies, and if the entire market dies, I'm sure it's going to affect you just as much. So we have to be realistic. We don't want them to convert. We don't want them to sell stock. Believe me, we absolutely don't. I specifically don't, but we have to work with them. It is a give and take. We have to allow them to have their stock, to sell their stock, to get cash, to put the cash back in, to allow us to keep breathing, but also to keep actually trying to grow in the direction we need to get us to the critical milestones. All the funders we've got now are OTC funders. They're not big board Nasdaq funders. I'm not saying they wouldn't fund at that level, but that's not their space. So we kind of they are an umbilical cord right now. They're an incubating fund to get to the big boards. Once we get to the big boards, we start to take down proper capital on proper terms, from bigger institutions, in bigger blocks, millions, 2s, 5s, 10s at a time, not pissing around with 25s and 50s and 100 grand at a time, on ridiculous terms. But it's a necessary evil to get there. And we believe once we get there, this short-term pain that we're going through right now will be very quickly forgotten. Once we're able to take down, 2s and 5s and 10s of proper money and be able to deploy our business and grow our businesses much faster, very quickly we'll quickly forget about a 25 grand note or a 100 grand note that was given out to a funder who sold and maybe hurt us short-term. It'll be very quickly forgotten. So just tapping on that, it's not something out of choice. It's not something we want to do. We do absolutely our best to maintain the relationships with the lenders, to try and nurture with them and work with them to try and not let them crush us, and not let them take for granted of us, but still trying to balance and getting cash out of them, which is what we need. So short term, there's not a lot we can do about it. If you look at the RB Capital consolidated note, 6.3 million, that consolidated note has terms built in there that we can pay $650,000 a quarter, and there'll be no conversions. So that's forward looking, which means that note is basically budgeted out over the next 2 to 3 years. We know this quarter there has to be a conversion. We have no choice. We need capital from them, and ultimately they need to get out of their position because we can't pay the 650. But hopefully by the next quarter, if not by the next quarter, certainly by the one after, we should be able to take down proper capital from our ILUS own uplist, or B, one of our subsidiary uplists, which allow us then to put a stop on conversions. And then we're at the point where we're now paying down debt, no more dilution, no more conversions, or minimal or better quality. So we have got all these things in mind, and we have sort of put in, let's say, stoppers along that journey to make sure that type of stuff is protecting us as much as we can. But I know it plays on everybody's minds. When interest rates hopefully start to reduce, a lot of the money should start to flow back into the market, and hopefully we got more access to more capital quicker anyway. And obviously we are, really, really close to our first uplist, the ASNS QIND uplist. As I said, the timelines are all publicized. It's in the 8Ks, it's in the material information that's already disclosed. We're in line with those timelines. So the light at the end of the tunnel is really close. Which hopefully should start to trigger, the first time that we're actually holding some real value on our balance sheet that's actually liquid enough that we can actually start to capitalize on, on some of our holdings and some of our asset values. So I'll leave that point, and we'll try and move on to some of the other business matters. So I'll talk a little bit about the regulators. I don't want to get into too much information, too much detail, because I don't really particularly want to create more enemies. We've got name changes applied for in ILUS and SAML. DRC also had their name change applied for. And we have this continual headwind with FINRA, and I believe now it's pretty much most OTC companies just not getting their corporate actions approved by FINRA, who's a self-imposed regulator. They're not even a regulator. However, OTC lean on them for, let's say, oversight, and that's obviously having a massive drastic impact. I mean, their modus operandi is protecting investors. Well, if they're happy for us to tell everybody we're a movie company and we're Illustrator movies, great, fine. We're a luggage company, but we're selling fire equipment, And I think that those days are going to come to an end. We've had a conversation with OTC, not me personally, but one of our subsidiary companies had a conversation with OTC. OTC asked them, is anything we can do to stop you going up to the big boards? And one of our answers, well, while FINRA is involved and we can't even change our name, how the hell do you expect us to operate as a business? It's just ridiculous, the amount of money. I'm not joking. On SAML, we've probably wasted close to $20,000 worth of fees and lawyers' fees just to try and change the name for FINRA to just keep asking stupid questions over and over again. Where's this document? It was in the original pack. Oh, sorry, we didn't see it. Where's this document? It's not notarized. Yes, it is. Look in the original pack. You wait a week. Oh, yes, sorry, we found it. Oh, what about this? But in the meantime, 60, 90, 120 days have passed. They're now asking questions that weren't relevant at the time of making your application. Things have moved on. So now, guy, you didn't disclose that you've got this convertible note. Yes, that was taken out 3 weeks ago. We made the application 4 months ago or 2 months ago or whatever. It's becoming a real hindrance on the OTC market, and I'm hoping OTC will start to take note of this and actually start to deal with it correctly. What their reason behind FINRA's behavior on blocking corporate actions is, I have no idea. We know it's not us. We know it's across the entire board. And that has to change. And hopefully it will. The good news for us is, certainly on a macro position is FINRA doesn't really have any say or involvement on the big boards, on NYSE or Nasdaq. So we're hoping that our days of having to deal with them are nearly coming to an end. Certainly on some of the subsidiaries as the uplist and as the ILUS uplist plans sort of start to materialize. And the same with on SEC, we have to be particularly careful around, because we've got multiple uplists happening at the same time, which not many companies do. We're obviously under a lot more scrutiny, or potentially maybe under a lot more scrutiny. So we're very particular on making sure that we do things right. Hence why there's less PRs, there's less tweets, there's less noise going out there. We kind of don't want to draw attention, or give SEC any reason to doubt us, question us, or have to ask us any questions about stuff that isn't absolutely crystal clear. So we're working quite closely with our attorneys to make sure that we dead on a clean track. And also with the multiple uplist strategies for the different businesses, which are all fluid. We'll either be filing S1s and S4s, which again requires SEC clearance, effectiveness. And it's really important that we kind of keep things nice and transparent and nice and clean to allow those to happen quickly. So people have asked, why aren't we disclosing about our deals? The deal, why haven't we announced them? Why haven't we signed LOIs? If you've got these deals that are really happening, why haven't you signed them? So that's part of the reason. Once we sign an LOI and we start to move towards a closing, we've got 71 days to file their audited financials. If they're private businesses, we've got to make sure that they're audited to PCOAB standards, which takes time, costs money, and ultimately then they will fall under the S1 or into the S4 registration filing, which we don't want to now make it longer and a slower process for SEC to have to say, you've acquired this business, but you haven't filed their audited financials yet. You're only on day 40, but we can't make you effective until you filed that. Or you've announced that you have signed an LOI with this particular company. We notice that you haven't closed, but you've signed an LOI. That's fine, but we want to know what that deal looks like. because it may affect the registration or allowing us to make this S4 or S1 effective. So they now want to dive into that particular deal, which doesn't make sense. It doesn't make sense to slow the whole deal, the whole clean business that we've got, the ILUS, SAML, QIND business. It doesn't make sense for us to basically put those documents out and kind of sign those LOIs and get that over the line and then slow down the whole process. So again, as we spoke about before, why we're not creating euphoria, why we're not coming out with regular news and PRs and kind of JPN on podcasts all the time. These are all sort of part of some of the reasons. It's very important. We're totally focused. Let's get ILUS, let's get QIND, let's get SAML done. Let's get those uplists done. Let's get access to proper capital so then we can execute deals properly, quickly, and effectively and grow them properly. Let's have the capital to help to grow our existing businesses aggressively and carry out those acquisitions underneath those subsidiaries. And that requires us to get these uplists done. While we continue to meander on without the uplist done, and we will continue to do that as long as it takes, because not all the uplists are going to happen simultaneously. They're at different times. Some may be pushed out. It just depends on how the market conditions move and the success of the first one. So that's sort of the overall picture on those, and we just wanted you to understand that, and kind of understand why we do things in certain ways. And now I just want to touch onto the actual uplists itself. There's multiple ways of us doing these uplists, and kind of, on the previous QIND we had filed in S1, to do an organic uplist, but I kind of just want to talk you through a very broad spectrum. I'm not going to get into the nitty gritty, but the very broad spectrum of the uplist. So you do an organic uplist, your float criteria is higher, your shareholder equity is higher, you go through the same process on an S1 to an S4, give or take, more or less the same time period. However, in order to meet the float, more than likely you'll have to raise capital. That raising capital is extremely difficult because we're trying to raise capital as an OTC company. You're basically raising capital, from the markets, saying we're an OTC company, we're trying to do this uplist, we need to take in $5 or $10 million on the uplist in order to meet our float, because we have to have $15 million of float, which obviously we don't have when we're nano micro cap, with the share trading the way it is. So, but now obviously the fund is always concerned that what if you don't close? The terms, they don't know how to value you because they don't know where the share price is going to be regarding of your valuation. There's all these different things. You don't want to give out the shares with lots of overhang, which is obviously what a lot of these companies that did uplists are now facing. They took the cash to meet the criteria. They uplisted and they've got gazillions of warrants. And just like the toxic funding on OTC, those institutions basically wanted to sell out of their warrants and just crush their stock price, push them below a $1, which they need to remain above $1 on average over 30 days. They got pushed below $1. They then get a delist notice. They then have to do a reverse split to push the price above $1. And so then their shareholders' equity is affected. And slowly this whole downward spiral basically consists. Only now people are on the big boards. So that organic uplisting process is very fragile to make sure you get it right, and basically not get yourself into trouble with having to take in toxic funding at a unrealistically low valuation, or take in funding that's got heavy amount of overhang. So you then go on to this RTO model, reverse takeover model, reverse merger, whatever you want to call it, which wasn't really a thing on Nasdaq previously. That was always an OTC play. That's now become a big a big Nasdaq and NYSE play. Why? Because there's 700 companies. Those that don't believe me, go to the Nasdaq website. Somewhere on there you'll find that the delist companies that are non-compliant, I think is what they call it. So basically the list of companies that are non-compliant. There's approximately 700. I think there was 740 or 750 when I looked the other day, which is a ridiculous amount of companies that are now in trouble. And those companies, I say in trouble, if their share price is below $1, they've got a delist notice. They can do a reverse split to get above $1, but probably they're going to get crushed back down again. So it's a short-term solution. Their shareholders' equity may be below the $2.5 million that it needs to as an ongoing listing, or below $5 million if it was a new listing. There's not a lot they can do about that unless they raise more money. If they're losing money, so they have to do a raise. But now they're raising money on basically more ridiculous terms because they're below the threshold, they're on a delist notice, so the funders take it for granted, take advantage of them. So those companies ultimately on a delist notice for a reason, and that has raised a whole lot of opportunities, that a lot of these companies are saying, okay, cool, we're actually good companies, we're good at what we do, we're actually relatively profitable, making 300 grand a year, 500 grand a year. We would be better off as a private company. We can't, for your information, it costs between $1 million and $1.5 million a year just to be listed on Nasdaq, with all the costs that go with it, D&O insurance and attorneys' fees and auditing and all that type of stuff. It's a very broad term, but that's more or less what it costs. So you need to be making $1 million, $1.5 million a year just to get to break even, once you've got all your Nasdaq costs involved. So if you're a small company making 500 grand a year, you're losing. At the end of the year, you're losing, even though you're profitable. So you've got a cash issue and you're chasing your tail. So those companies ultimately now maybe thought they could grow faster, took down money for whatever reason to do the uplist, thinking it was all unicorns and rainbows once they were up there. For whatever reason, it just hasn't worked out for them. So those companies are now looking to do deals, just like on the OTC days. Basically, they want to find a company who's going to come into their vehicle. They're going to leave and go private or sell or close down or whatever they're going to do, and somebody's going to take over their vehicle and deliver a shareholder value for the shares that are outstanding. Just a copy-paste repeat of the OTC model that's happened for the last 50 years, 20 years, I don't know. But on Nasdaq, or on NYSE, that never really was an occurrence. But obviously, as the market got tougher in OTC, more and more nano micro caps rushed up to OTC, to the big boards, and just couldn't sustain it. And as I've said from day one, we can't sustain it unless we've got some proper critical mass. We've obviously, as I've said, we've said before, and JP's repeated, we've got this deal flow. The moment we get up, the moment our registration is closed and we're now officially in the driving seat on the big boards, we'll very quickly close the deals we need to close. Very quickly, I'm talking within months. So we're not concerned about our revenue, because these are deals we've already done the due diligence. We're already a long way through. We could push to close them quickly if we really needed to. But as refer back to the beginning of this conversation, we don't want to create a mess with our registration statements. So on that basis, it's important that we get up, take down the cash, and close these deals, because we can't stay at 15, 10, 11, 12, 15 million revenue on QIND. For a year. We just can't. We'll get eaten alive. We'll be one of the next 700 companies that get delisted. We've got to push that up. We've got to push, while our profitability, at 1.8 million will put us profitable even with that, going beyond, into the next stage. We need to get that up to 5, 6, 10 million, net income to be able to sustain going forward nice and comfortably. And then the value starts to come. You'll be able to take better quality capital and you'll be able to roll bigger deals on. So again, our plan is very, very clear. Our belief in our plan is very strong. Our execution is going as fast as we possibly can, sensibly and sustainably. So coming back on the point, so we either got an organic uplist, which I've just mentioned on the 15 million float and 5 million shareholders equity, and you're raising money on a weaker valuation, or you do an RTO, which typically are much more predictable, which is obviously is this ASNS deal, is because the capital is able to be taken down, during the course of the deal. Not necessarily at the end, because the vehicle is already in Nasdaq, or in NYSE, it's already a big board company. It's able to take down capital slightly better because it's already operating, and so there's a little bit more predictability. And you're not hoping you're going to uplist, hoping you're going to be able to raise the money. In this instance, kind of the money's taken down, or even in the bank. Some of the shells have the money in the bank account, and they're going to spin out and leave the money in the bank account. So there's more predictability around that, although the timelines are not a million miles off. I'll talk about the ASNS deal in itself another day. The material information that's out there is as much as we can give you right now. And particularly the important thing is the timelines that are there are pretty crystal clear, and we're tracking well within time to get that done. So hopefully that gives you a little bit more information on the uplist side, and kind of how that all fits together, and kind of the different considerations, and particularly why we've pivoted away in certain ways, and why we kind of haven't announced certain things, and we're kind of keeping things relatively fluid, to execute these deals one by one, in a very, very short time period. And we hope, and we're pretty sure that that's all start to deliver some real value at the ILUS level, and allow us to execute the overall plan. So talking a little bit about, it's connected to the last topic about the dilution, and our outstanding. Yes, we did say, we were trying to keep our outstanding under $1 billion. I've touched on this already. A lot of water's flown under the bridge since then. Market conditions have changed considerably, which has made it more difficult to raise money. The share prices have moved considerably, which has made it difficult to raise money at a sensible share price. So if you look at how much we have raised over the last, let's say, 12, 18 months at a share price of 2 cents, 3 cents, or 6 cents, how many shares would we have issued? I haven't done the numbers, by the way, but it's probably not a million miles off, the billion that we hoped we were going to stick close to. But at the current share price, there's not a lot we could have done. It's either that or, we just shut the shop and turn the lights off and all go and play on the beach. That's not what we're here for. We're trying to grow up a proper business and trying to grow this conglomerate, and that is what we will do. If we have to pivot and move along the way and take some short-term pain, then so be it. That's a decision that we have to make as a board. And we've made the decision, and we'll continue to make those decisions as need be to reach our ultimate goal. So that being said, and then obviously that we're still in the market continue. People talking about the outstanding, a number of shares outstanding. And I think my personal, I know this is not an economist or an analyst's view, but the parity between the number of shares outstanding, the number of shares in the float, the number of shares free trading, the share price, and the liquidity, I'm not sure actually all benchmarks as it should do on paper. For example, if we have a look at ASNS was a good example. Their stock last week they traded, I don't know exactly what it was, let's say 80 million shares in the day. More than $250 million of stock traded in one day. Well, they've got less than 5 million shares out, physically out. So, tell me how they trade 80 million shares and there's only 5 million shares issued. You tell me the answer. It's naked selling, opposite of naked shorting. So, certainly on the big boards, the parity between number of shares and what's actually going on is slightly different. And we know that happens on our account as well. It only really happens with people with a prime brokerage account, which is really the bigger institutions. But we know it happens. In days where we have a ridiculous amount of stock traded, it's not always valid, real stock trading, in our opinion. But anyway, it's irrelevant. I kind of just wanted to, just highlight that point where people have, spoken about the number of shares trading and kind of, the real position around the share price and versus the number of shares trading. And that'll become particularly prominent when we start to go into the big boards and you start to see the movement. The second example is MEDS, MEDS. If you have a look back at their history, similar sort of thing. They also had tens of millions of shares trading where they've got almost no shares out. Again, it's the naked selling model. So, it was really, the point of this conversation was really just more informative for you guys rather than anything factual or meaningful. So I will end it there today. Thank you for listening in to me. It's obviously a relatively long podcast, a lot of information. I don't believe there's that much there that is new to anybody. Which again reaffirms our consistency on where we're trying to go as a business and our overall strategy and our overall plan, and our mission to achieve that and deliver that. And again, it sort of reaffirms that we're not a million miles off our plan. So please, be patient with us. We thank you very much for your support. We thank you very much for your loyalty. We do hear your frustrations. We feel your frustrations. We understand your frustrations. And believe me, on days that you guys feel frustrated, you can rest assured JP and I are equally or more frustrated because we're actually in the engine room trying to get things done with all these external influences that keep putting spanners in our works. But that doesn't deter us. If it was easy, everybody would do it. I don't think there's one, or certainly not many great businesses, on this earth that have been created easily. Things take time. Things are hard work. We've got to have resilience, and we've got to be, stick to our word. We've got to stick to our guns, and we've got to have thick skin. It takes a hell of a lot of beating out there. Whether it's from shareholders, from Wall Street, from funders, from investors, from SEC, from attorneys, from whatever. We take a beating on a daily basis to get through this. And the glass ceiling is pretty thick. But as we've said, we're really grateful, for your support, and we believe we're really, really close now. And hopefully we'll all start to feel a little bit easier, kind of by Q4. We'd like to think about to do a podcast from that point and be in a very, very different position to where we are today, and actually, people will be able to start to feel and see the valuation a little bit more clearly, and see where we're going a little bit more clearly. And I'll wrap it up there. So thank you very much, everybody, and we look forward to to the future. Let me just add one more thing. Sorry, my normal style shareholder meeting. There will still be a shareholder meeting basically called the moment we have transparency on closing of ASNS, and kind of the route forward for the other vehicles is allowed to be announced and allowed to be publicized. We don't want to sit for a shareholder meeting and basically say this is what we're doing, and then 4 days later it's slightly moved off course and you guys will just say, oh, you guys flipping mental. We don't want that point from ourselves and from you. We want that shareholder meeting to be very conductive to positive and constructive conversation about the next 12 months. And we're sorry it hasn't happened yet, but we believe we took the right course on not calling the meeting so far. But again, it is going to happen, and it's going to happen soonish. Just bear with us on getting this ASNS deal done, and then pushing on with our plan. So thank you very much for everyone, and we will keep in touch.